So again, welcome everyone to the webinar today, 2024 Election Insights, where we're going to cover 2025 tax policy outlook and year-end planning. This is scheduled to go for 3 hours. I'm kidding, of course, till lunch. So hopefully we're at lunch, but so 1 hour today. We'll be launching 4 poll questions throughout the webinar for CPE credit tracking. To receive credit, you've got to participate in at least 3 of 4. So, pardon me. Please note that 3 or 4. If you have any questions, submit them to the question feature there on your screen. And if we can't address them, we'll try to follow up with you after the webinar. We did get some questions before the webinar we'll try to cover as we go along here. The presentation slides can be downloaded from the handout section. The webinar is being recorded, so you can review it again and again and again as your heart desires. And there will be a short survey at the end of the webinar. So please fill that out and let us know. And CPE certificates should be sent via email within 7 days of the webinar today. So with that, I'm going to go ahead and get started, Jim, if we're good to go here.
Yes.
So
Welcome.
Welcome everybody. Hold on a second. Let me see if I can get, there we go. We'll jump through the legal disclaimer. Please review that at your leisure. So our agenda today, we're gonna cover the election results, congressional leaders that we believe we'll be dealing with for tax policy, the TCJA sunset. We'll talk about those specific provisions. We're going to talk a little bit about the reconciliation process in tax legislation, what that looks like, what that's going to mean, what are some of the obstacles, tax provisions in 2025 legislation, so really TCJA and then other proposals, the timing of tax legislation in 2025, and then we'll kind of hit some the grand finale of what are some observations we have, and then what do we think potentially some possible tax legislation for before year end, right, in the lame duck session. So we're going to hit a poll question here real quick. So Jim, you want to read that?
Yeah, our first polling question here for everyone, if you could please answer it. Which current issue are you most concerned about following the election? We've got several choices here. The first one, the federal debt, income taxes, and inflation. So again, this is just your preference. No right or wrong answer, if you will, but
this is like the sausage race at the Brewers game. This is very close.
Yeah, it is. Back and forth. They're going for position here. It's a photo finish here. Almost everybody's voted here.
Wow, that's interesting.
We'll close that in a moment here. Okay, Our polling is ended here. Thank you for all responding on that. The federal debt at 35%, income taxes 29%, and inflation 35%. So pretty split across the board here with it on that first poll. So thank you very much for responding. Interesting.
Okay. So we'll thanks, Jim. Continue with election analysis on tax policy. So as we know, President-elect Trump was elected to a second term, very close, or a highly contested race, but not necessarily as close as maybe what the polls anticipated. And of course, now we've got this new tool out there, the betting, some of the betting sites, which frankly were better predictors than the polls in by some case. So, and Trump also leads and probably wins the popular vote. We're still counting votes, as we know, in the House. So there's still votes being counted out west for the most part. And so final tallies will come on that. So in the U.S. Senate, the Democrats today hold a very narrow margin of 51 to 49. Republicans have flipped 4 seats, And so I think it's pretty well settled. It's a 53-47 margin. Pennsylvania is still, I think, very close, and maybe there's some votes to be counted. I haven't checked in the last day or so, but I think generally everybody's accepted the fact that the Republican candidate in Pennsylvania for Senate has won. So in the House, as of, we scheduled this to make sure that we got to a result. So, I mean, we did hit the date. Kidding, of course. I mean, it's been a long slog, but most of the major news outlets are calling it that the Republicans have won 218 seats, projected to win 220. That's basically two or three, seat majority, which is very, very thin. So we'll talk more about that. But there's still some seats outstanding. So we'll see what that final tally is. But it looks like, for the most part, we can assume that the House has gone to the Republicans. So a Republican sweep again, which I mentioned earlier, if you weren't on. This is the fifth new president, right? New president, not incumbent, that has controlled both chambers of Congress coming into their presidency. So with that, I'm going to turn over to Jim. Jim's going to talk about some of the key congressional leaders for tax policy. Jim.
Good. Thank you, Tom. Thank you. Good morning, everyone, again. These are some of the, we put down as just, it's important to know some of these key leaders, both in Congress, both in the Senate and the House, because they're going to drive a lot of the legislation going forward here. And these are the anticipated leadership. Again, some have been announced, but we wanted to make sure that you're aware of these. First in the Senate Majority Leader, the Senate Republican Caucus actually voted just yesterday, and John Thune of South Dakota was named as the leader. He'll be the new Senate Majority Leader. Mitch McConnell from Kentucky opted earlier in the year not to run or to seek the majority leadership role. He'll still be in the Senate, but will not be the majority leader. Thune won that position over John Cornyn of Texas and Rick Scott of Florida. The Senate minority leader will be Chuck Schumer of New York. He had been the majority leader the last several years. So again, Thune will be a key player in moving some of the tax policy moving forward here this year. In the House side, the Speaker of the House, again, Mike Johnson, the Republican caucus approved him, voted for him yesterday. They will have a full vote for that in January with the full House, but he will be the Speaker of the House. The House Majority Leader, also from Louisiana, Steve Scalise, and the House Minority Leader, Hakeem Jeffries from New York. Other leadership positions will also be determined. Again, members of both the House and the Senate are determining those leadership positions this week when they came back after the election. So again, some of those have to be, they start at the top and work through those, and those are going to be done over this next week. On the tax writing committees, these are very important. These are the ones that are going to implement or push through the actual legislation. The Senate Finance Committee, the chairman will be Mike Crapo from Idaho, and the ranking member is Ron Wyden. And though Wyden had been the Senate Finance Committee chair the last number of years, he will move to the ranking member. And then Crapo had been on the Senate Finance Committee in that ranking role before. In the House Ways and Means Committee, Chairman Jason Smith will continue in that role. He's from Missouri, and the ranking member will be Richard Neal from Massachusetts. So again, anytime you hear any of comments in the news on tax policy, and you hear something that's one of these players, especially if they're the chairman of those committees, that's going to be something to make note of, because again, they're very influential in pushing tax policy. Administration, unsure at this point some of the roles. Again, some of the key positions for tax policy be the Treasury Secretary, IRS Commissioner. I think the existing commissioner will stay on and again may step down at some point, and then the administration would appoint a new one. The Treasury Secretary, announcement could come today. I've heard that Howard Lutnick was from Cantor Fitzgerald Investment Group CEO. Is speculation may be appointed or nominated for that, but again, we haven't seen anything official for Treasury Secretary. That could come in the next day or so. So again, that will be a key part of the administration in moving any tax legislation going forward. And again, these positions, as long as some of the other ones that were announced in the last few days, again, do need to get confirmed by the Senate. We'll move now to our second poll question here. We'll launch that now. Okay, which best describes your preference regarding the TCJA provisions scheduled to expire? Again, these are scheduled to expire at the end of next year. We've got extend the TCJA provisions regardless of the deficit increase. Our second one, extend the TCJA provisions that are set to sunset with no increase to the federal deficit. And then the third is allow TCJA provisions to expire.
I think we've got a clear winner here, Jim.
It's not as close as the first one.
No, I think in this sausage race, the winner just took the other two out.
I think this was the bratwurst. I think I pulled ahead here, Tom, for it. So, okay, still I'm gonna go over 80% voted here. Okay, we just ended the poll here. 14% is the first one. Extend the TCJA provision regardless of the deficit increase. 74% are our leader or winner with that is extend the TCJA provision with no increase to the federal debt. And then the last, allow the TCJA provisions to expire or to lapse, that was 12%. So interesting split there. Again, 3/4 of it being our second choice there. Thank you very much.
Well, and it's telling because, I think people are, increasingly concerned about, deficit spending here and deficit cuts. So that's interesting for those in elected office. So let's cover a few of the major tax provisions. Most of the major tax provisions that were from what we fondly refer to as the Tax Cuts and Jobs Act. As we know, prior to the election, we sort of faced this cliff at the end of next year of a lot of these provisions expiring, which of course today, as we sit here, we still do. But there's optimism now with some of what we heard from the president and some of the congressional leaders on the Republican side that they generally favor extending those cuts with maybe some enhancements, maybe some new tax breaks. And of course, as we saw from the poll, most of us today on this webinar would favor, extension, but not deficit increasing extension or just a tax cut package in general that wasn't, deficit increasing. So, the way they, as we'll get into, Jim will get into a little bit, the way they get these bills passed, they try to stay within a deficit number, if you will. And so I think, that just increases the overall debt. And I think there's less and less patience with that. So use this reconciliation process, which we'll get into in greater detail a little later. So what are some of these provisions? Of course, the biggest one that affects all of us is the income tax rate, the brackets, right? And so the brackets became, more taxpayer friendly, 7 tax brackets, and you would be able to pay a sort of a lesser rate for more income, essentially, as a general rule, with the TCJA brackets that were put in place. And of course, the highest bracket was reduced from 39.6 to 37%. The QBI deduction was very popular, reduced pass-through income down, from the highest rate, which was 37, down to 29.6%. So really reduced for those that qualified, and there were some rules around that, as we know. Some didn't, some phased out. So that's a major provision that would expire if nothing were done in the coming year. So TCJA nearly doubled the standard deduction, That was kind of part of a goal to simplify the tax code, less itemizers. The itemizers really went down once that was put in place. So that's a big one. And then the child tax credit was put in place. It was raised from 1,000 to 2,000 with a phase out, and of course, sort of in conjunction with that, the personal exemption went away. So they kind of replaced the personal exemption with this child tax credit. Mortgage interest deduction limitation was at 750. We're still there, obviously today, but that was a change of TCJA, and then the SALT deduction cap, which was a big one, which was really more of a pay for, right? How much state and local tax you could itemize and deduct, and that's going to be a real point of contention. We'll talk a little bit more about that as we go along here too. So 2% miscellaneous itemized deductions basically went away under the Tax Act. Again, pay for, right, sort of took a potential deduction away from those that were affected. The P's adjustment went away as well. That was really a phase out for higher income taxpayers. You started to lose some of your itemized deductions, up to 80% of them. So it's almost like an additional tax, if you will, because you lose deductions. And then the EMT exemption, again, to simplify the tax code, was raised, and it really took a lot of taxpayers from having exposure to AMT. So, and then some other provisions that will sunset or expire. Estate and gift, really big deal for those high wealth taxpayers. It was basically doubled, if you will, 13,610,000 per person, or 27 million for a married couple. That would effectively be cut in half upon expiration of TCJA. And then some international tax changes, FDI, GILTI, and actually BEAT as well. Those taxes would go up a little bit if the TCJA would expire. So some things that won't sunset or expire, but they certainly are some of them are evolving, if you will. Research expenditures, as we know, we now have to capitalize those versus immediate expensing. Interest expense limitation under 263J is an ongoing, that's one that hits some of our clients, and that limitation is not set to expire. Bonus depreciation is still around. It's not expiring, but it continues to phase down each year until it gets to zero. So we've got a few years left. There's some bonus depreciation. And then once M&I expensing, that also does not expire. That'll continue to stay around. So these were all permanent changes. Again, with like the bonus, there is kind of a phase down there that we have to be aware of.
Including the Tom on that too is the corporate rate at 21%.
Thank you. Yeah.
Permanent one, and that's not scheduled to sunset.
Yeah, thank you. I jumped right over that, didn't I? Yeah, that corporate rate being reduced was a big deal. Went from 35% down to 21, and that's a pretty big deal, and that's permanent as well. So, and then a couple other credits. These are more sort of extenders, right? Some of these credits they don't make them permanent, and so they're to some extent historically they've continued to extend them, and so many believe that they are like they're permanent, but there still is a expiration date on some of these. So the new markets tax credit is a very popular credit. Work opportunity is also a highly used credit. Empowerment zone tax incentives. And then, a new one is this exclusion from individual income tax, the payments of student loans, from employer payments of student loans. That's also expires at the end of 25. So there's just a little bit of history and the things to look for on TCJA if those would expire. So Jim, I'll turn it back over to you here.
Good. Thank you, Tom. Yeah, it's really kind of fascinating sequence of events that have kind of played out with the tax policy and the TCJA that Tom talked about. Again, that was a important part of President Trump in his first term was to pass that bill. And many of those changes, as Tom mentioned, were not permanent. They're set to expire again next year. And now, he's going to be back in office and dealing with it again with Congress. So just the way that played out was kind of interesting. I think it's important to note not only with that TCJA had used reconciliation, but how that's going to be used in a tax bill next year. And again, when we were planning the session here, there's really sort of two avenues or paths that a tax bill can go through Congress with it. And that really depended on what happened with the House, and if the House had been in a Democratic control, it would be a different process to move a tax legislation through. But with the Republicans being in control of not only the House but the Senate, the expectation is, and some of the leadership have already mentioned it, is they're going to use this reconciliation route. So we'll talk about that. Again, with them being in control of the House and Senate, again, that just really came to finalize, if you will, last night when they called the House for the Republicans. When a party has all three of that, the House, the Senate, and also the White House, they often use reconciliation to pass a tax bill. It's a special rule to enact legislation allows a bill only need a simple majority in the House and the Senate. You may have seen sometime, if you've seen certain bills, when it gets to the Senate, they need 60 votes to block a filibuster. So to get legislation through, they need 60 votes, and a lot of legislation does not move ahead if they can't get to that threshold. If they use reconciliation, then they only need the 50 votes with it, again, with the vice president casting a tie-breaking vote. So that's why the reconciliation would be used in this case for a tax bill. It's not all legislation that can follow as reconciliation. Again, it's budget-type bills, including tax bills, and there's generally only one reconciliation bill that's adopted in a legislative year with it. So anyway, that's one thing to note. So they're not going to be able to push a number of these. It's going to be everything that they're going to want to include. They'll be in this one bill this year. Again, reconciliation we put down here is a real political power play control. When you're in control of the entire process, you're going to use that, and the other party, the minority, is kind of left out of the legislative process. They, can try to offer their input with it, but they're really immobile with it, and the majority works to pass the bill. And both sides have used the reconciliation to pass legislation in recent years. Tom mentioned earlier the Inflation Reduction Act 2 years ago. That was reconciliation, as was the American Rescue Plan. This TCJA that we'll be talking about actually was under reconciliation. And I think going back a number of years, the ACA, was under reconciliation. So again, majority will go along. They'll craft the bill to obtain the necessary votes to get it through both the House and the Senate, and eventually, if they've got some members that want certain things, that they'll adjust the bill to make sure they get everybody on board with it. So, next slide here, Tom, with it. After the bill is passed, one thing to note is if there is somehow determined that there was a technical correction or there's an error, something that needs to be fixed in the bill, you would think they would get those fixed relatively easily. Minority party that was left out of the process, though, is not willing to fix a bill later, even if it's only a minor technical correction. It sometimes can take years to fix something because, again, when they fix that bill, it's going to be a 60-vote margin with it, and again, it takes a while to get those done. These politicians have long memories when it comes to bills under reconciliation, and again, that's worked on both sides of the aisle with it over the last number of years. If the bill is a bipartisan bill, not under reconciliation, then it's usually much easier to fix it. So anyway, just something to be aware of. So what the expectations are, the Republicans will use the reconciliation route to pass the tax bill next year. They've already made comments to that, and they'll work forward with it. Again, reconciliation has a number of set of rules that they're going to have to follow in Congress. Very complicated provisions that they've got to work with, and they sometimes get the Senate parliamentarian involved. But the first thing that they'll do with it is, the leadership, and again, this would be in the House and the Senate, is they pass what they call a joint budget resolution that they come out, and that sets the amount of the tax cuts or the deficit that they'll have in the budget period. That budget period, I think, is up to 10 years, and in some cases is less than that. I think the TCJA was an 8-year period, and we'll talk about that. Maybe this budget period could be a shorter period. It could maybe 5 years. They may not go the full 10 years, just based on what the change would be in the deficit with it. So they set that target amount. We'll talk about that too, and then they have the reconciliation instructions. This gets passed by the House and the Senate. That doesn't have to go to the president. Okay, this is just their guide that they've got to follow these rules, and they then go to each of the tax writing committees to draft the specific legislation. There's some other committee members that may have parts of it, but the key part will be that tax bill that goes to the House and the Senate with it. There may be some, we put in here what they call some pay-fors or some offsets. These are provisions that actually we would say are revenue raisers. They increase taxes. And again, they're going to have some tax cuts on one hand, maybe some offsets, some revenue raisers to come to somewhat net number that they're going to be able to include in the overall package with it. Tom mentioned the salt cap, the $10,000 limit that was in TCJA. That was an offset they put in. Some of these other items that they put in there in the TCJA or coming up for renewal, they have to look at. Excuse me. There could be some other items that come up in this bill that there could be some pay-fors or offsets. But the key thing is, as they try to determine how much of a tax cut to get, but they're going to have to balance that. Again, the Republicans control the House and the Senate, but have narrow margins with it, so they can't, lose too many members in either the House or the Senate to pass their bills. So if the tax cut that they look to push through is too much, and some are concerned to say they don't want to add to the deficit, then they might lose some membership. So they're going to have to find a middle ground as to where they can get everybody on board in both the Republicans in both the House and the Senate to set that number as to what those cuts are going to be. Then they leave it to the tax writing committees, both the House and the Senate, to graph the specific details. And our next slide kind of highlights that. It's two key questions that politicians, lobbyists, and tax professionals are going to be interested in as you get to the first part of the year is, what's this number? This number, and again, that's the net amount of tax cuts or the increase in the debt that is going to come out, and it's going to be in the tax bill. The TCJA, it was $1.5 trillion was the tax cuts or the increase in the debt that was in there. So there could be some debate, discussion, speculation as what this number is going to be. And once they set that, that's the size of the box. All the other tax cuts have to fit in there. And again, there could be tax reductions, there could be increases. Those have to fit within the overall budget number that they have. And the next question is what's the score? And this is not the latest football or basketball game or whatever that's out there, but it's the impact of each provision as they look at the special provisions, whether it's the income tax rates, some of these itemized deductions that Tom talked about, some of the other provisions that came up in the campaign that might get included within there. And that's the score that the staff of the Joint Committee on Taxation looks at and says, okay, during this budget window, what's the change in revenue with that going to be? That's an important number because that gets combined with all the other changes to see how much room that they have within the total budget that they can include. So anyway, these are important items that will come up next year, and you may see some referring to that. The other thing, and Tom and I have talked on this a little bit too, is that as you're trying to provide or continue these tax cuts, is the tax relief may promote some economic growth and generate some new tax revenues. And again, that's what this joint committee, the staff does is, factor some of that in. So when you do have some tax cuts, even though you get a reduction in the revenue, might that spur some economic growth that actually might collect some additional revenue with it. The same with one is this bonus depreciation. When you have that, companies go out and buy some additional equipment, that might increase some additional revenue as it goes sort of downstream toward those that make some of that equipment, that they employ some more people. And Tom found this statistic here that revenue created by these types of provisions can range from 1% to 14%. So when you get this tax cut, you might get some additional revenue and stimulation in the economy from that. So again, that's all when it gets into some of the in the weeds, if you will, some of the detail of what happens when you have some of the cuts. How does that affect the overall budget? How does that affect the score and fit into this plan? So those are some of the details you may not need to be worried about, but those are going to be very important to both politicians in Congress as they craft this bill and those who, come up with the score.
All right, Jim, we got another poll question here.
Okay, our third question here, our poll question. So please respond to this. Regarding the individual SALT cap of $10,000 that Tom talked about, which would you prefer? So again, we got three choices here. Allow the cap to expire, allowing unlimited deductions. So to increase that and have it back to what it used to be is you can deduct more than $10,000. Our next choice, increase the SALT deduction cap to a more reasonable amount. Whether that's $20,000, $30,000, $40,000, somewhere in there maybe, or keep the SALT cap the same at this $10,000. So I'll give you a few moments to answer that. Again, we've got a number have already voted here.
We got a couple of questions. Maybe we can go over just real quick, Jim, as we let people answer. With the tax provision set to expire as of the end of 25, does that mean they need to act to extend before the end of 25 or before the end of 26? So yeah, they would need to act before the end of 25, right?
So next year. What they'd like to do is do it before then,
sure.
So the people can plan. But they have had situations where a bill would go even past that and then make it retroactive to the year. So, there's nothing to say that, if it got into, for some reason, they didn't get it done this next year or next, spring or summer with it and went to the fall and it moved into early January or February of 26, it could be, done retroactive. They've done that in some cases, but they prefer not to have that. So we'll have to watch that. Okay, we ended the poll here. 31% allow the cap to expire, allowing unlimited deductions. 52% are majority here. Increase the SALT limit, but just a more reasonable amount. Again, could be 30, 40, 50,000 perhaps, somewhere in there. Or keep the SALT limit the same, 17%. So thank you very much for your responses here.
Yeah, and by the way, the SALT deduction, Jim talked about the score, is if they would allow that to go unlimited, it would really be an expensive tax provision in terms of its effect on the deficit. So interesting question. The other question that was out there, Jim, is it possible bonus depreciation goes back to 100%? And the answer is, anything is possible. I will tell you that the bonus depreciation and R&D expensing are scored. Well, I shouldn't use that word, but they studies have shown they really create a lot of economic growth. So if we start to see recessionary pressures, I think you will see that the pressure to bring that back.
Agreed. Okay, so what we're going to look at now as we kind of change gears. After looking at the reconciliation process, the role it's going to have is, okay, what might some of those provisions be? If they're going to move this bill into reconciliation, what are we going to look at? What's some of the provisions that the Republicans would include in their legislation? And again, the House may move their bill, the Senate may have theirs, and again, they're going to have to iron out any differences. First thing we're going to look at is I'm going to go through some of the TCJA provisions that Tom just talked about that sunset at the end of 25. And what may come of those when we get to the new year and they push this tax bill forward. And then Tom's going to look at some of the proposals that came out during the campaign that were out there, and some of those are going to be part of this legislation as well. So there's going to be really sort of two baskets of type of items that get that included within it. And again, they all have to fit within this package that meets the reconciliation rules. First thing is the TCJA provisions that are going to expire at the end of 25. Many of those will likely be extended. That's the key thing that they ran on, is to extend those provisions. What's uncertain, and we talked on this a little bit, when they set this reconciliation and they come up with the overall number, we're not sure how long that extension may be. again, the TCJA won 8 years. It could be a shorter period. Some are speculating they may have a shorter time frame with this bill just because of all the items they want to include in there. Instead of going out to 10 years or 8 years, maybe it's a 3 to 5 year period. And then some of these particular items, we'll have an extension period, 3, 4, 5 years, whatever it is. Some may be made permanent. They might try that, but again, we'll have to see how that plays out. The other one is when they extend these, are they going to keep those in the current form, or are they going to change those in some manner? Again, one example again is the salt limit. Is it going to be extended, or is it going to be changed in some manner? The same with some of these other items. Not only is when they're going to be effective, but are they going to be the same way? So again, when we put the slide together, we assume the Republicans do have a sweep. They do have that now with the House coming in last night. So I would look. The expectation is that the individual tax rates will continue on through 25 into 26, and again, however long that they schedule those out. So there's not going to be an increase in those rates that is scheduled to sunset at the end of 25. The QBI deduction that Tom talked about, that will also be extended. That's one that, again, many of small businesses have taken advantage of. Also look for the standard deduction to be extended. The higher AMT exemption will be extended. The estate and gift exemption will likely be extended. There was some talk that was going to come back to about half of what it is, and there would be a lot of planning this next year. There still may be some planning with it, but I think there's less concern that rate is going to drop down as there was maybe a couple weeks ago. Although there could be some pushback on that estate and gift. We'll have to see how that plays out, but at least it looks for those key items as far as the tax rates, the QBI deduction, standard deduction, AMT, and the gift exemption, that those are going to be extended beyond 2025. That's going to be part of the bill that they're going to include. Next, here's a couple of provisions, though, that are set to, sunset next year, and I think have maybe at least an uncertain fate next year, at least at this point. The first is we've talked on, and Tom mentioned the salt cap, this $10,000 salt cap. And again, that was our polling question. There's certain Republicans and Democrats, they have the salt caucus, if you will. It's sort of a small group in Congress that are very concerned with it. That's a higher tax state, both at the state income tax or property tax, and they want that limit either taken away or greatly increased, and they're going to monitor any legislation very closely with that. So if it doesn't have an increase in it, some Republicans maybe push back against the bill if they don't get that increased. The President Trump mentioned even in the campaign he'd like to see that removed or changed. So the expectations are that would be at least increased, maybe the $30,000 to $50,000 or perhaps more. Again, some are trying to get that repealed. I guess they'd be surprised if it stayed at the $10,000 limit. This is what we've seen. But again, this has to get scored here, as Tom said, and repealing that would be a big score as far as additional cut, that they're going to watch that closely. So another thing that's come up, we saw in the last couple of days, is if they're looking for another pay for or an offset, is some have suggested maybe they would put a salt cap in on C corporations. That's kind of a new one, but that might come up there. I don't know what that limit would be. I'd imagine it would be much more than $10,000, but that's a potential to keep our eye on with it. As they're trying to craft some legislation to fit within how much room they have with the overall score, is maybe to have a cap with C corp. So something to watch. The other one is a child credit that Tom talked on. Again, it had been increased from $1,000 to $2,000. There was talk in the campaign to even make that higher, $3,000 or even higher. That's something that, again, that can be very expensive. The score on that's very expensive, but that's one that I think the leadership and the committees may look at. That may not be in the first year, but it may be over the budget period that they look to increase that child credit. Next thing, again, as far as some other ones that have this uncertain fate, we talked on that, and the questions came up on this too, is these three items that kind of move together that are very popular with a lot of business, especially some closely held one, is this R&D research expenditures, the interest limit, and the bonus depreciation. Again, there was a bill earlier this year that would go back and get the 100% bonus, allow expensing of research expenses, and change the interest limit so that you can add back depreciation, amortization to that limitation. What's possible is that those be included within this bill to, again, expand those deductions with it. The question would be is, what would that change entail and what would be the effective date? Would it be prospective only? Would it be retroactive? Or would it maybe give an option for the taxpayer to select? I'm going to keep using one of these items. I'm going to maybe apply it going prospectively. So it's still early to tell on that, but that's something to monitor as the bill moves forward. Is what are they going to do with, as Tom said, the bonus depreciation? They're going to go back to 100, which seems to be, again, the president made some references both toward the expensing and the bonus depreciation to push those up to 100%. So that could work its way into the bill. It's just, again, what is the specific details of that change and what are the effective dates with it? Next slide with it, again, and this is still relates to the TCJA, but these are some comments that the President Trump had mentioned. Is he likes the 100% bonus depreciation, so that could, push the House and the Senate leadership and the tax writing committees to include that in some manner. Again, what the specific terms are and effective dates will be, we'll have to watch. R&D credits, expanding the 100% expensing. And even the 179. So he's mentioned that in some of the campaign. Again, it's all going to see how much of these overall provisions can they fit in, or can they squeeze in this box of tax cuts that they're trying to do. But these are some of the ones that the president has pushed for. So now we'll look at, again, these were some TCJA items that are in there. Now we're going to look at some other proposals that were not part of TCJA, but were part of the campaign. Many of you heard of them, and Tom's going to go through some of those next year.
Thanks, Jim. Well done. One thing I do want to refer back to the interest expense limitation. One of the ideas that's been thrown around is those of you that may be affected or track that particular provision, that at one point the calculation of interest limitation was based, the adjusted taxable income included depreciation expense as an add back. So the base number where that limitation was applied to was higher, right? There's some discussion of maybe bringing that depreciation back into that calculation, which again would reduce the limitation. So that's one of the ideas. So here on the corporate tax rates, of course, they really reduced the corporate tax rates. That was really designed to make the U.S. more competitive, right, with the international community in terms of the tax rates. Somewhat controversial that they went all the way down to 21%. I think they wanted to go lower, but again, I think the scoring had something to do with that number they landed on. But here we are again. Trump wants to go to 15%. How would he do that? Well, potentially, apply, for example, the QBI deduction, that goes to pass-throughs. Maybe he provides that deduction to C Corps now. That has been kicked around. So, one of the things we're going to see this theme again and again is U.S.-based companies, right? U.S.-based companies would get the lower tax rate. So, really kind of more protectionism type of policy. So foreign manufacturing, corporations that offshore would not be eligible for that 15%, and then we get into some of the discussion about tariffs. Imported products would be subject to tariffs. A lot of details to be worked out on this, how this is going to work. Remember, during his campaign, Trump did talk specifically about John Deere. John Deere came out and announced they were going to move jobs to Mexico, and he sort of called them out. So you might remember, I think it was Whirlpool in his first term, right, was going to move a bunch of jobs from up in northern Illinois down to or northwestern Illinois down to Mexico, and I think he actually was successful in sort of reverting that. So, again, really trying to support U.S. manufacturing. Couple of other things Trump talked about. You might remember he was in Las Vegas when he announced this. Hey, tip income would be excluded from individual income tax, right? Focused on restaurant and hospitality industries. How would he do that, right? I mean, if somebody brought their tax return in, maybe they pay me in tips now instead of for the actual service. And those kinds of questions start to come about. I mean, what's a tip? Probably, as Jim and I thought about this, maybe there's a tax credit and that they give to workers in those industries and for actually reporting and paying both income tax and payroll tax on those tips, and maybe they limit it to a certain amount of tips. Probably a way you could implement something like that. Same thing with this promise of maybe overtime pay. It's an interesting idea, right? I mean, maybe it improves the productivity of our workforce in the U.S. So, maybe it does make the U.S. more competitive, but in practice, how do you implement something like that? Do more workers go from salary to hourly? But remains to be seen how that will work, right? Social Security benefits exempt from income tax. Difficult to pass because it's not permitted under the reconciliation rules. However, maybe we're moving toward trying to do some things about the looming Social Security and Medicare fund crisis. So that would probably have to be part of would have to be part of a separate bipartisan Social Security bill. But was an idea that Trump threw out there. And I think one thing we know about him is he will take his to-do list and go execute on it. I think he showed that in his first term. Temporary deduction for home generators, in response to recent disasters. That one, the only real detail we have is that it would be retroactive back to September 1. So it would cover that time frame of when we had those hurricanes in Florida, be a 1 year deduction. So we'll see how that plays out. Individual taxpayer, some other things here, eliminate worldwide income on expats, to reduce the overall sort of this double taxation that many Americans face living abroad. Interest paid on auto loans, right? Interest rates are higher. The auto industry probably moving less cars. I think that's been published. I've seen some of that. Maybe an above the line deduction, so not an itemized deduction, but to an above the line deduction. Here again, U.S. Manufactured autos, right? So how's that defined? Don't know, right? Don't know. SALT deduction, wants to repeal the SALT cap on state and local taxes. So we expect this to be a fiercely debated issue, right? There's the SALT caucus. The SALT caucus has, I read last night, 10 Republican members. Of course, the House, that's on the House side. So that's enough to stop any bill, right? When you have a 2 or 3 vote margin in your party. So very thin margin. We'll see how that plays out, but it's also a very expensive provision to rescind. So some other ideas out there. There's a lot of good ideas out there. We'll see how some play out, but allowing parents to deduct certain expenses related to having a newborn child, right? I mean, we sort of encouraging folks to have more kids and giving them a tax break to do that. Expansion of contributions to Section 529 education savings accounts, tax credit for first-time home buyers, tax credit for caregivers. A lot of these things are reflective of, as a country, some behaviors that are just realities of aging population. First-time home buyers having trouble buying homes. How do we legislate that into the tax policy? So, noble ideas. We'll see how those play out. Not a lot of details. Of course, we've heard a lot about tariffs, right? China, it's been pretty well publicized. China's, dumping a lot of subsidized goods in Europe. They've implemented some tariffs. I think that there's an interest in increasing the tariffs to a pretty significant number on any imports from China. So, and then just tariffs in general on imports from elsewhere. Also talking about, as a pay for taxing large endowment funds. So, one of the things to remember about tariffs today, these tariffs don't get a score, as Jim talked about. So that doesn't really, at least under the current rules, increase the tax revenue as the joint committee would score any kind of tax legislation. Now, spoiler alert, wait for it. They may change the rules or find a way to fit that tariff revenue into that process. I don't know. So where does it get paid for? One of the pay fors, and I saw this question earlier come through. They're talking about rolling back some of the IRA energy incentives that to reduce that, obviously reduce tax revenues because we're giving folks tax credits to purchase and install green energy type um, you know construction materials. Um, there's a lot of lawmakers that may not support this position because they see it being benefiting their constituents, right? So in a slide here, this is a letter in August where it was signed by 18 members of the House to the Speaker and said, hey, taking this widespread cut to those credits could really be a detriment to our constituency, so I expect some of that will happen, frankly, but I think they'll take more of a sort of a scalpel approach to it, and we'll see what happens. And of course, the other interesting thing is here we've got Elon Musk who sells electric vehicles as a big part of Trump's team. So interesting sort of bedfellows, if you will, when it comes to some of the green energy stuff. So, but I think it is being kicked around. I think they're looking at that as a potential pay for. The other one is, of course, reducing the IRS's budget. And specifically in the enforcement area. So if you look, they increased their budget almost 80 billion over 10 years. 45.6 of that was for enforcement. Subsequent bipartisan legislation to get passed, they reduced the enforcement budget by 20.2 billion. You could see some cuts in the IRS budget as a pay for, specifically on the enforcement side. So look for those things. So anyway, just some additional proposals. Jim, you want to take us through the last?
Yeah. We'll move to our next polling question here, our fourth one. Do you believe tax legislation will pass in 2025? Okay, yes or no. So there's no maybe here, it's just yes or no. I'll give you a few moments to pass this. People are voting quickly here.
I think we've convinced them, Jim, that something's going to happen. No, but there's some naysayers, and you've rightfully so, right? I mean, there's a thin margin in the House.
You never know. That's right. So we've got just about completed here. Okay, we ended the poll here. 92% said yes, it will pass. 8% no. So thank you for responding on the poll question. We'll see what plays out here. I think the odds of getting that legislation again change once Republicans have the control and can use that reconciliation. Briefly, just want to go through the expectation here as far as the timing. In the TCJA, that was pushed back in 2017. It was late in the year. It was the fall when that came out, and they actually signed it into law mid-December. The timeline for this reconciliation bill, however, in 2025 here could differ. It could be the first part of the year. Steve Scalise, who's the House Majority Leader, mentioned last week, I think Friday last week, that he's interested in pushing the tax bill through reconciliation, and he's looking to get the administration to do that in the first 100 days. Again, that's an ambitious target. There's so many things that go into it. First, they set this, the total number that they're going to have, and then they draft a bill. There's a lot that needs to go in there to do that. The first 100 days, I think, is a lot, but if it's the first half of the year, I wouldn't be surprised with that. So we'll keep our eye on that. But at least that's their stated objective, is to pass that soon. The first key one is when they get that joint budget resolution we talked about. What's that overall score going to be? What's that budget period? What are the instructions? That will get them started with actually crafting the actual legislation. So we'll keep our eye on that. Again, that would be early in Jan. They've already started to work on that now, some of those people involved in that. And the other one is, we've talked on this, and what are the various effective dates going to be on some of these provisions? Besides the overall timing of a bill when it might pass, in April or May or whatever it might be, is particular provisions. They're going to be effective when the bill is signed into law. Will be a prospective, like starting in 2026 maybe, or will some even be perhaps retroactive? So those are some things we'll have to keep our eye on with it. And again, every time they change the effective date on that, that affects the score. So that's why that score is always important when they do that. So we'll keep our eye on these effective dates.
Okay, so having said all those things, what are some of our observations? We'll have more details, as those staff start writing those bills and implementing or writing the legislation that will come out, and so sort of wait and see. But I think the tendencies are to legislate for the short term, and I think we, as planners and as business owners and so forth, with Republican control, they're going to try to legislate their agenda over the next 2 years. They're going to try to, spur economic growth. Trump has a lot of power right now in these first 2 years, and then he becomes a lame duck president, as we know. So I think that he will pass his agenda. The question is, at what cost? As Jim has alluded to, I think it's very, very possible that we see a tax bill with some of these provisions that expires in a shorter time frame, right? Because it increases the deficit less, right? The less years you have these tax breaks, the less of a deficit increase, the less the deficit would increase. So I think that that's really a possibility to try to appease those of us that are sort of budget hawks. Jim, you want to talk about sort of political control?
And again, as Tom mentioned before here, this control of Congress seemed every new president who's come in has had control of the House and the Senate. So again, and we've had changes over the last 15, 20 years where different parties in charge, and they'll get control of the Senate and they'll unwind some of these things. So we need to keep that in perspective with it. Look at your plan, and you do plan for the long run, but it's hard to gauge out tax policy more than I think 3 to 4 years with it, just because of the changing dynamic with it. The deficit that Tom talked about before here with it, again, where the government receipts are and the spending, there's a 4 to 6% shortfall. And again, just doing this over the long haul indefinitely is not really viable here. And something's going to have to give. So it's going to be looking at maybe a mix of spending cuts and enhanced revenue. One thing to note, though, is, and again, some of the Republicans have mentioned that enhanced revenue through growth doesn't necessarily mean tax rates are going up. They could keep the rates at the same or drop them, but perhaps they spur the economy to grow some. So just something to keep in mind.
And of course, as we look at this next slide, and we're getting close to our time here, tariffs are one of the offsets, right? How's that going to affect inflation? Those are all concerns that everybody has. The last time we had this tariff was as I mentioned earlier, if you were on early, Grover Cleveland lost the presidency to actually maybe the only Indiana president, which was Benjamin Harrison, and then he won the presidency again 4 years later. So he is like Trump. He had 4 years off and came back. So that, but anyway, that's the last time we had this real tariff debate. and they saw a lot of increased costs and products back then. Now the world is a lot different than it was in the late 1800s, so we'll see how that plays. Um, I think the point here is, in general, I would tell you, you have 4 years probably of fairly positive tax policy, right? And I would fully expect in 2 years. I mean, it's historically in the midterm. The party that's not in control of the White House usually gains some ground, right? In maybe one or both uh, chambers of Congress. So I think you've got 4 years, and then I think we may see some less friendly tax policy. So we encourage everyone to really take advantage of those next 4 years and do some planning, because I think all of these deficits and interest costs and everything are going to be we're going to have to deal with it. So the last thing we have here is just what are some things to expect before year end. Um, you know, the disaster relief may include some tax provisions, some tax breaks, may not, but they're certainly going to try to look at disaster relief. They got to fund the government. We're here again. We got to have fund the government, probably a continuing resolution. And a national defense bill is something they do every year. So look for that. So there's some things on the agenda here. And then the debt limit increase, as we turn the page on the new year, we're going to be at the debt limit again. So interesting times for politics. But with that, Jim, I don't know if you have any final thoughts. We're at time, and we want to be respectful of folks' time.
Yeah, we appreciate you being in, and we're going to keep going with the series here as this plays out. Again, this is sort of the launch with it. We'll have other webinars again as the move forward with this reconciliation when some of the bill comes out, or when some of this other policy is laid out. We'll continue to have that and follow it. Again, if it's going to be the first part of the year, we'll include those, and you can go on this journey with us as we go down this tax legislation this next year. So thank you for being with us.
Thank you very much, and everyone have a great day and a great weekend, and happy Thanksgiving to you all.
Thank you.